welcome. We're going to be talking about employee retention tax credits, qualifications, benefits, and refunds today. We have our handy dandy disclaimer here that essentially says don't try this at home without a professional guiding you. But seriously, if you have any questions, we're always available to help. And so anything we discuss here today, there are certain areas of the law that are not 100% clear, so just proceed cautiously and know that this is still an emerging area for both the government and for those practitioners that are trying to follow along and help their clients, and for the taxpayers who are trying to implement it as well. My name is Jason Melillo, and I've got Ian Williams here with me. Ian will be answering questions in the background as we go throughout the presentation. We are KBKG, established in 1999 with offices across the US. We provide turnkey tax solutions to CPAs and businesses, and we've performed thousands of these types of projects, resulting in hundreds of millions of dollars in benefits for our clients. Our team is a diverse mix of tax specialists, attorneys, engineers from various disciplines. This combination of talent allows us to be the best at what we do and maximize results for our clients. And we are a preferred provider for thousands of CPAs across the country. All right, so as I mentioned, I'm Jason Melillo, and I'm joined by Ian Williams. We've got a lot of information to cover, and we've only got an hour, so let's get into it. So the employee retention credit was first launched with the CARES Act back in March of 2020. Like the PPP program, it was designed to encourage businesses to keep employees on their payroll. It was amended and extended under sections 206 and 207 of the Taxpayer Certainty and Disaster Tax Relief Act, or otherwise known as the TCD-TRA. Like the Economic Aid Act, the TCD-TRA was part of the Consolidated Appropriations Act of 2021. Section 206 essentially allowed for those who had taken PPP loans to now qualify for the ERTC. Originally, when the act was introduced, the government had indicated that if you receive PPP funds that you wouldn't be eligible for ERTC, and that changed in December of 2020. And then under Section 207, what it did was it extended the time frame from January 1, 2021 to June 30, 2021, and then also increased the amount of credit from 50% to 70%, and increased the dollar amounts from $10,000 a year to $10,000 per quarter. So there's an opportunity to retroactively apply for credits in 2020, even if the employer received a PPP loan from the SBA. I'm sure that many of you realize that, and we've seen a lot of people going back, claiming credit, and there's a lot of people still recognizing, okay, you know, I kind of got things in order. I got my PPP taken care of. I've got my forgiveness taken care of. Now I want to go back and figure out what else I can do. So this is definitely one of those things. There is an ability to receive credit in advance, although I'll talk a little bit about that. There's a caveat to it, and I think that at least until something changes with the IRS, I would recommend that you don't apply for the advance credit, because I don't think you'll get it before you timely file a 941. So there was a final change under ARPA, the American Rescue Plan Act, that extended the ERTC from June 30 to December 31, 2021. So we now have all of 2021 to work with. It also made some other minor changes. Certain startup businesses which began carrying on a trade or business after February 15, 2020 are now eligible for up to $50,000 per quarter, even if the eligibility tests are not met. And we'll talk about all those eligibility tests and all that stuff shortly. So the average gross receipts can't exceed $1 million for this startup business benefit. Employers of all sizes who received a reduction in gross receipts of more than 90% compared to the same 2019 quarter are now eligible for a credit on all employee wages. So Again, we'll talk about how people qualify and what some of the limitations are. There are some limitations based on size. This is one exception, that regardless of how many employees you have, if you had a 90% reduction in gross receipts when compared to 2019 for a quarter, then all employees would qualify for the ERTC. And then they also lengthen the statute of limitations for this particular area from 3 to 5 years. Clearly, the IRS, under-resourced, as many of us know, now has all these additional burdens placed upon it. So I think that's going to take them some time to ramp up, and in order to make sure that they have time to audit those that they feel they need to audit, they need an extended statute. So other dates that are important, the original act, March 13th, 2020 to December 31, 2020. The new act was January 1 to June 30th, which now has been extended to December 31. Important here is notice 2021-20 is the first guidance that was released that has any authoritative credibility. Everything else was just FAQs on the website. So now you have something that you could at least hang your hat on. And notice 2021-23 deals with the first and second quarters of 2021. There's also another notice that was published last week that doesn't really have any new information, just talks a little bit about the extension of time from first and second quarters to third and fourth. So really what you're looking for in the way of authoritative guidance is going to mostly be in 2021-20. So who are the qualifying employers? Employers who fully or partially suspend operations during any calendar quarter of 2020 or 2021 due to orders from an appropriate governmental authority limiting commerce, travel, or group meetings for commercial, social, religious, or other purposes due to COVID-19, or, and that or distinction is important, employers with revenue in any quarter of 2020 that was less than 50% of the revenue when comparing to the same quarter of 2019, employers of any size, including tax-exempt organizations, but not governmental entities. And I'm going to cover some of the little differences in 2021. Employers with revenue in any quarter of 2021 that is less than 80% of the revenue comparing against the same quarter of 2019. So a much lower threshold. We don't have to have 50% lost revenue. It could be 20% lost revenue. And we're seeing that anyone that was down, that 20% threshold is actually a pretty reasonable threshold. We have a lot of businesses that we're seeing that were just over 20% down in that 20 to 25% range. So I think they did have some good intelligence when they were setting these thresholds. Employers that were not in existence in 2019 would substitute 2020 for 2019 above. Employers of any size, including tax-exempt organizations, colleges, universities, hospitals, and medical care providers. This is just, it was expanded a little bit because they realized that places like university hospitals were excluded under the original act. Eligible employers must maintain documentation to support the determination of the decline in gross receipts. Pretty obvious here that you want to make sure that you can support and substantiate anything that you do. So, like I said, there's two ways to qualify: a reduction in gross receipts or governmental orders that require any type of shutdown. So what are those types of governmental orders? Any order from the city's mayor stating that all non-essential businesses must close for a specified period. State emergency proclamations that residents must shelter in place for a specified period, other than residents who are employed by an essential business and who may travel to and from work in the workplace location. An order from a local official imposing a curfew on residents that impacts operating hours of a trade or business for a specified period. An order from a local health department mandating workplace closure for cleaning and disinfecting. We saw governors establish governmental orders. We saw courts establish governmental orders. We saw the Surgeon General establish governmental orders. So there are a ton of them out there. And that's probably the most difficult aspect of navigating how and whether or not a particular business was shut down and how were they shut down. We'll go through a number of examples today. So let's start off with this one. We've got governor statewide issues an order that all non-essential businesses must close from March 20 to April 30. The order provides a list of non-essential businesses, including gyms, spas, nightclubs, barbershops, hair salons, tattoo parlors, physical therapy offices, waxing salons, fitness centers, bowling alleys, arcades, racetracks, indoor children's play areas, theaters, chiropractors, planetariums, museums, and performing arts centers. And you know, that's just a few. There's a ton more than that in reality were actually subject to many of these orders. But it does give you an idea of the types of things that were shut down. And certainly across many of the states that varied. You know, employers that provide essential services, many of them were open. The governor's order is a governmental order limiting operations of non-essential businesses, entitling employers with non-essential businesses to claim the employee retention credit for qualified wages. So that's the example of a statewide issue or order. Then we have things like a mayor of city Y holds a press conference in which she encourages residents to practice social distancing to prevent the spread of COVID-19. The statement during the press conference was not an order limiting commerce, travel, or group meetings. Accordingly, the mayor's statement would not be a governmental order for purposes of the employee retention credit. So you see the distinction there. One is a requirement, one is an encouragement. And we saw a lot of both. But the governmental orders, they're in writing, they're signed, they're dated, and they're abundant. We've got another one here. Employers see a software development company maintains an office in the city where the mayor has ordered only essential businesses may operate. Employer sees business is not essential under the mayor's order, which requires Employer C to close its office. Prior to the governmental order, all employees of the company teleworked once or twice a week, and business meetings were held at various locations. Following the governmental order, the company ordered mandatory telework for all employees, limiting client meetings to telephone or video conferences. Employer C's operations are not considered to be fully or partially suspended by governmental order because its business operations may continue in a comparable manner. And that's something that we'll see that's thematic is, you know, was our business disrupted in a way that we really couldn't function in a way that we did prior to the pandemic? And I've got examples of both sides of this. One more example here that I think is a great one. We've got Employer D operates a physical therapy facility in a city where the mayor has ordered that only essential businesses may operate. Employer D is not considered essential under the mayor's order, which requires Employer D to close its workplace. Prior to the governmental order, none of the D's employees provided services through telework, and all appointments, administration, and other duties were carried out by Employer D's at Employer D's workplace. Following the governmental order, Employer D moved to an online format and is able to serve some clients remotely, but employees can't access specific equipment or tools that they typically use in therapy, and not all clients can be served remotely. So Employer D's business operations are considered to be partially suspended by governmental order because in Employer D's workplace, access to therapy equipment is essential for them to conduct the majority of their business, and they can't continue in a comparable manner. So you see the distinction there. Someone's not disrupted versus someone who their operation is truly disrupted. And I'll give you later on the guidelines of how they establish what is considered disrupted or not. So if an employee's workplace is closed by governmental order, but the employer is able to continue operations comparable to operations prior to closure, including by requiring its employees to telework, the employer's operations are not considered to have been fully or partially suspended as a consequence of governmental order. And you'll see that there are these benchmarks here, factors to consider for determining comparable operations, employers' telework activities. Does the employer have support to make this happen? Were they already set up? As many of those in the CPA profession have been doing for years, there's the ability to work from home and access information remotely. But if we've got a manufacturing operation, line workers can't bring the manufacturing line home. So how portable is our employees' work? Is it a matter of unplugging the laptop and taking it home? Or is it a matter of, moving a piece of machinery home to, does someone have a drill press that they're going to have delivered to their garage and they're going to try and work remotely? So how easy it is for the work to be transferred. And the need for presence in the employee's physical workspace. Can the employee's remote workspace be adapted to accommodate the needs of the business? Again, we're not going to send expensive machinery to somebody's home so they can work from home. If they're a line worker, they're going to have to work in the plant, or if they're shut down, then they wouldn't be able to for whatever period of time that shutdown order was in place. And then transitioning to telework. How long did it take to make the changes necessary for the employee to be effective? A lot of medical facilities, doctors' offices, and things like that were able to adopt to telework, but they didn't have the infrastructure set up. It took them a couple of weeks to get it going. If they didn't have anything in place and they needed to coordinate with their IT professionals, that might have been something at the beginning of the pandemic that took some time, because IT professionals were very busy helping people get things set up, and everybody was trying to set things up at the same time. So it may have been a number of weeks that even somebody who had the ability to move things remote, it took them time to set up remotely, and so during that time frame, they would qualify for shutdown. So partial suspensions of trade or business operations, an employer that maintains both essential and non-essential businesses, each of which are more than a nominal portion of the business operations, and I'll explain what nominal is in a second, may be considered to have a partial suspension of its business operations if a governmental order restricts the operations of the non-essential portion of the business, even if the essential portion of the business is unaffected. So solely for purposes of the employee retention credit, a portion of the employer's business operations will be deemed to constitute more than a nominal portion of its business operations if either the gross receipts from that portion of the business operations is not less than 10% of the total gross receipts, both determined using the same calendar quarter of 2019, or, remember, or, important here, the total hours of service performed by employees in that portion of the business is not less than 10% of the total hours performed by all employees in the employer's business, both determined using the number of hours of service performed by employees in the same calendar quarter of 2019. I've got a great example to illustrate that. We've got employer A operates an auto parts manufacturing and distribution business. A supplier of raw materials is required to fully suspend its operations due to governmental order. Employer A is unable to procure these raw materials from another supplier. So employer A is still able to secure other products related to its distribution business. Manufacturing business represents 20% of its business, distribution represents 80%. The total sales during the same quarter when compared to 2019. So if 20% of our sales in 2019 were from manufacturing, we don't have the supplies, we don't have raw materials, that is a partial shutdown, but that means then our whole operation qualifies because it's more than 10%. So I've got another one here, and this is a brick and mortar operation that has an online element as well. And actually the online element is bigger than the brick and mortar operation. But the brick and mortar operation was partially shut down. And on the basis of gross receipts, brick and mortar of the business represented less than 10% of total gross receipts. This means that it would constitute a nominal portion and not more than a nominal portion of its business. It means that they don't qualify under that particular aspect. However, when you look at the hours of service performed, it was determined that the brick and mortar locations actually accounted for about 30% of the total hours in that quarter of 2019. And because of this, the company was able to apply the total service hours approach to show the physical locations represented more than a nominal portion of business operations, which allowed the partial shutdown order to be applied to the entire company, granting eligibility for the credit. So that was big because the number of employees and the credit amount was substantial when being able to bring in all of the employees from the online business. So you can see kind of how that works and how it benefits the taxpayer. Let's talk about how to calculate the gross receipts. This is again a qualification criterion. If we're not subject to a shutdown, then the other thing that we'll look at is the gross receipts. For-profit entity, we're looking at total sales, less returns and allowances, plus investment income, interest, dividends, rents, royalties, and annuities, less adjusted basis and assets sold. So the example I like to point out here, because we've seen this a number of times, where you have some pre-revenue companies out there that were working off of Series A, Series B type funding, or they had money that they had in the bank that they were kind of using to run their operations. They had investment income from that, and as they were spending that down, that investment income was decreasing. And if in 2020 you had a more than 50% decrease in investment income because you didn't have any other revenue, that still qualified. In 2021, obviously, if it's 20% or more, that would qualify. So something to we've seen happen on a number of occasions, and it's a great way for someone that really needs it to qualify. Nonprofit entities also would qualify under the same criterion, same basics, but we've also got contributions, gifts, grants, and member dues that would also be factored into the calculation. So I talked that there were some limitations on the number of employees. In 2020, you have to look at 2019 in both cases to determine how many full-time employees are evaluated. And for 2020, it's 100. So if you have 100 or less employees that are considered full-time under the ERTC rules, and I'll cover those in a minute, then every employee, assuming the company qualifies, can qualify for the credit. And that number changes for 2021. If you're greater than 100, then only those employees that were paid to stay home, essentially, would qualify for the credit. And I'm going to go through some examples that will kind of help drive this home. For 2021, that number was increased to 500. So we still look to 2019 for the threshold, but if we had less than 500 or less in 2019, then every one of our employees, assuming the company qualifies, would qualify for the credit. And I'll, like I said, go through these examples that'll help make it more clear. So first of all, what is a full-time employee? Well, under the ERTC rules, if you have at least 30 hours of work per week or 130 hours of service per month, you're counted as a full-time employee. So essentially, you're required to look month by month at the number of people that cross that threshold, and then add them up for the month, total them all the way across January through December, and divide by 12, and that results in the average full-time employees for the year. And if you have less than 12 months of operation during the year, then you would just take the number of months, do the same calculation for the number of months that you were in operation, and the divisor becomes that number. So if you were in business for 6 months, you're dividing by 6. If you started an operation in 2020, then you would use the 2020 numbers. Same methodology. So qualified wages and credit. Qualified wages are all wages paid to employees within the determined period, plus all qualified healthcare costs. So when you think of all wages, that's all wages as defined under Code Section 3121, which includes things like tips. So, I encourage you to go look at those rules if you're doing this for your clients. Make sure you understand what wages would qualify. Wages are limited to $10,000 per qualified employee per year for the periods beginning March 13, 2020, ending December 31, 2020. And the credit amount is 50% of those qualified wages for 2020. For 2021, wages are limited to $10,000 per qualified employee per quarter for the periods beginning January 1, 2021, and ending December 31, 2021. And the credit amount is 70% of the qualified wages. So that's where the $7,000 per quarter comes from. 10% times 70%, and 10,000 times 70% is 7,000. So for both, note that wages used to qualify for forgiveness related to first draw or second draw PPP loans do not qualify for ERTC. There's no double dipping. I'm going to drive that point home a number of times today, so forgive me for repeating myself. Here's an example of how the calculation works, super simple. Manufacturing company with 10 employees has revenues in Q1 of 2021 of only 70% of the total revenues when compared to Q1 of 2019. Note that none of these wages qualify to offset the PPP forgiveness. So since we're down more than 20%, all of our employees qualify up to 10,000 per employee. So you see employee 1 had 25,000 wages, 10,000 that are eligible for the ERC, and 70%, that's $7,000 of credit, all the way down to employee 10, $1,800 of wages, 70%, $1,260. So you can see out of our 107,000 wages, 55,000 of them qualified or were credits. So let's look at another example that PPP is involved. The same manufacturing company was down more than 50% in revenue during Q2 when compared to 2019. We're talking about 2020. So revenue for Q3 and Q4 was less than 80%. So they qualify for Q2, Q3, and Q4. The company also received a $225,000 PPP loan in Q2 and used a 24-week period for forgiveness. So again, we have our Q4 wages. We've already in Q2, Q3 in that 24-week period used up some of those PPP wages. We've got a little bit left over in Q4. So you can see we're burning those off. So employee 1, 25,000 wages, 8,000 of those were used to satisfy the PPP forgiveness. 17,000 are available for ERTC. We've got 10,000 is our limit, so 10,000 times 50% is $5,000. So you see how that works. And then down at the bottom, you've got employee 10 started after none of those wages were used to qualify for PPP forgiveness, so they're all used for ERC. So you see how that works and the impact it has. Now, there is an optimization process that we're doing on these engagements to make sure that you prioritize the PPP because obviously that is something that is tax-free. There is no tax impact for the PPP forgiveness. So we always want to make sure that we get that 100%. If the client can qualify for forgiveness under PPP, that's the priority. However, what we're finding is when, especially in Q1 and Q2 of 2021, when there's a crossover period, there is an opportunity to kind of look at that. When do we start our PPP forgiveness? If we know we're qualifying in Q1 and not qualifying in Q2 for ERC, then it's very important that we max out ERC in Q1. If we know we're getting it both in Q1 and Q2, then it's a matter of working with the company to understand how much payroll do they have, how are they going to be able to max out their forgiveness on PPP, how long is it going to take, and just really working with those numbers to ensure that not only are you going to get full forgiveness of the PPP, but that you get the most amount of credit under the ERC. So here's another example. This is a large employer. This is somebody who had more than 100 full-time employees when they measured it in 2019. So in response to the governmental order that they were shut down under, the employer reduced their hours by 50% and reduced its employees' wages by 40%. So again, because they were more than 100 employees, they don't get the ERC on all their 100 employees like they would if they were 100 or less. So they only get it on employees that were paid to stay home. So because they reduced their comp 40%, but the employees were staying home 50% of the time, there's a portion of that would qualify for the ERC. And so that 10% gets calculated into the employee retention credit. And then they paid 100% of the employees' healthcare expenses. So the 50% of the healthcare expenses that they paid for their employees to stay at home is also fully qualified for the ERC. So this is where a larger company would qualify. Another example here, if we've got furloughed employees, we're a large eligible employer, subject to governmental order that fully suspended operations of its trade or business. They laid off or furloughed their employees, but they continue to pay their health insurance 100%. 100% of those health insurance costs would qualify as wages under the ERTC because those employees were staying home. We got to talk about affiliation rules because for many of you, you have more than just one entity that needs to be considered or factored in. And we look for these aggregation rules, we looked at two sections, Code Section 414M and O, as well as IRC Section 52A or B. Under 414, an affiliated service group is treated as a common employer based on rules, based on the performance of services of one entity for the benefit of another. Typically, we're talking about a management company. So we've got, 2 or 3 businesses that are operating, or 100, it doesn't matter, but we've got a management company. They're all operating as kind of a single unit that would qualify under 414M. 52, that's where we're looking at brother sister groups. If we've got 5 or fewer people that own 80% or more, that would qualify. If we've got a parent subsidiary group where we're greater than 50% of the ownership of the subsidiaries, that qualifies. It's a combined group if 3 or more corporations, each of which is either a parent or subsidiary or brother sister control group. This is all under 52A, which is corporate. 52B is trust, partnerships, and the like. Same basic thing, just different entity types. So let's get into a couple of examples. We've got a taxpayer that owns 80% of 2 restaurant partnerships and 100% of an affiliated management company. One of the restaurants is a full-service restaurant and it's been shut down for dine-in meals due to governmental order. The other restaurant was a takeout restaurant and was unaffected by the shutdown. So how do we determine whether or not any of these companies qualify and which sales are considered? So let's look at the sales here in our example. Our dine-in is in the upper left quadrant. We've got 2019 and 2020. You can see that they were impacted dramatically in Q2 and Q4. And they were down more than 50% in both quarters. They were never over 80% the prior year when comparing to 2019. So if you were looking at it on its own, it would qualify starting in Q2. But when we look at the takeout, we can see that they actually went up because people were not able to eat in restaurants. They were getting takeout food. And so in this case, because of the ownership, greater than 80%, 5 or fewer people, we have to aggregate. And we also have to aggregate this management company, which was down. But when you look at the aggregated totals, we were never down more than 50%. So we don't qualify under the revenue rules. But if you remember in my initial explanation of the example, the dine-in restaurant was shut down. And because they were shut down, that lets the whole group qualify. So as long as the dine-in was more than a nominal amount, remember that nominal 10% amount, which clearly it is, then the whole enterprise is considered to be shut down. So when you start to think about chain operators that have 10, 20, 30, 100 locations, if more than 10% of those locations were shut down either based on revenue or based on hours worked in 2019, then that's more than a nominal amount and we can qualify the whole thing, assuming that we meet the aggregation requirements. So I kind of went through this already. Here's the solution so you understand. Remember that the wages that were used for PPP forgiveness may not be used for ERTC. So let's look at another example. We've got the taxpayer owns 50% of 2 restaurant partnerships and 100% of affiliated management company. And one of the restaurants is a full service restaurant and has been shut down for dining meals due to governmental order. The other restaurant was only takeout and has been unaffected. Same exact example. We're going to assume here that we don't qualify under 414M. And here we're not aggregating, right? Because we're saying that each of these needs to be looked at under their own basis. And as a result, then we don't get to do anything with the dine-in, right? Or I'm sorry, we do get to do something with the dine-in because they were down more than 50%. We don't get to do anything with the takeout, and we don't get to do anything with the management. So you can see here that because of the reduced sales at 50%, we qualify for the dine-in starting in Q2, and we would qualify all the way through Q4. Again, PPP wages, don't use those for ERTC. So how do we claim the credit if the employer's employment tax deposits are not sufficient to cover the credit? And they never are. They won't ever be, because the amount of credit is significantly greater than the amount of the payroll tax. You can request an advance credit by filing a Form 7200. Now, when I started off, I said that that's something you can do, but I would warn you against it. And the only reason I say that is because our experience has been that the companies that are filing these, it's going to the IRS. And like many things going to the IRS right now, it's going there and it's sitting there because the IRS doesn't have enough resources to respond to it. They don't have enough resources to process it and issue a check. So where we have seen the best success is when someone files a timely filed 941. So again, a 941X, we've got to do it for 2020. It's after the fact. If we're now just looking at Q1, we're going to do it for Q1. But for Q2, we've got time. We're in Q2 right now. So we can actually get projects done. And as soon as the quarter ends, make sure that those credits are requested on a timely filed 941. And we have been seeing that timely filed 941s for Q1, the checks were being processed and refunded back to clients. So that's our suggestion to you. If the IRS is able to start processing things sooner, you can make that request. We're in Q2 right now. You could make a request of the 7,200 and get advanced funds if they were on top of it. So hopefully they will get a turnaround fairly soon. I'm not holding my breath, but I'm hoping for the best. The other way is you could immediately reduce payroll tax deposits that are otherwise required to make and claim that on the 941 that was done and reduce the amount of the credit based on payroll tax deposits that were reduced. By and large, the practice has not been for people to do that. They're afraid to do it, and I understand why, trust funds and all. And it just complicates things. ADP, Paychex, and Paylocity, the payroll service providers, they are able to turn that off, but I think people are just afraid to do it for whatever reason. So most people are not doing that, but there's nothing wrong with it. You're allowed to do it. So I'm going to skip this example because it's kind of redundant. Here's the form, simple form. There's not a lot on it. I will say that the IRS has a number of comments that they make about the form, just saying use a professional to fill it out, get a CPA to fill it out, or make sure that you have someone look at it, do it right, because their claim is that they're going to kick it back if there's anything wrong with it. So there's not that many numbers on it. It's not that complicated. Make sure it's signed. But like I said, I wouldn't go out of my way to file many of these if you can just file a timely file return. I think you'll see your money much quicker. No banking information is required. The IRS is going to double check the address, and they will issue a letter, 6313 letter, if the address on the 7200 is different from the most recently filed 941. Understandable, they're just trying to prevent fraud. There is a rule that if the amount requested is greater than 70% of the average quarterly wages paid in 2019, so somebody who had more wages in 2020 or 2021 now at this point than they had in 2019, you're going to be limited to your 2019 wages for the advance credit. On the 941, you'll still be able to get your full credit. They're just not going to allow you to advance more than what your 2019 average quarterly wages were. So some final tax considerations. Income tax deductions must be reduced by the amount of credit received in the year that the credit was generated. So, we're past the filing deadline now, but let's say that you have a client that's on extension and they haven't done the ERC credit yet, but they're going to. Well, you can't file that return until you know how much the amount of the credit is from the employee retention credit for 2020, because it's an add back to the wages So just keep that in mind for planning purposes. You kind of have to get the ERC stuff done first. I would say that, clearly I mentioned this before, you can file an amended payroll tax return. Any amended payroll tax returns have to be amended prior to April 15th, 2026. So you've got plenty of time to do that. I don't know why you wouldn't do it immediately, because the sooner you do it, the sooner you get your money. PPP forgiveness is completely tax-free, so the coordination of ERTC and PPP is important in order to optimize the tax benefits of both. Do I have anything else here? Oh, it is a service we provide. We're happy to help. We're happy to be a resource for you. We're happy to just answer questions if you want to bounce it off of us. We're doing a lot of this. We're seeing a lot of different ways that we're able to help people qualify that might otherwise be on the bubble. We're not letting people go over the line, but certainly there are a number of areas where it's just not clear. There's not a lot of guidance, and we're doing a lot of research to get comfortable with what can be done and what can't be. So that's something that I think we found is helpful and an advantage.
So yeah, we've got our typical S Corp majority shareholder questions. I know a lot of you guys have sent that question through, and I probably didn't answer all of them because we're going to handle that one here live. So generally the answer and the limited guidance that we have, any majority shareholder of an S Corp or any other corporation is not going to be eligible for this credit, along with any of their relatives that are on payroll. And the one kind of key there is if it's a husband wife who own 49 and 51%, spouse ownership is attributed to each other, so that would effectively be both of them owning 100%, which would rule them both out. There is a list of the types of relatives that should be included on payroll, but I would just say generally, if there's any relative of yours as a majority owner, of your client as majority owners that are on payroll, then they're most likely not going to be able to be included for the credit. Anything to add there, Jason?
No, I think that's been probably the number one question asked by people, I think that we're still seeing. I mean, we haven't even seen much guidance beyond that 2021-20 and the FAQs, but I imagine at some point we're going to see more in some of these questions. Look, the AICPA has been pinging Treasury and the IRS on this stuff weekly, and it hasn't been answered. So some of these questions that exist out there are a little bit nebulous, and at some point there's got to be some release of information that would clarify. What else are we seeing?
We got a few questions on restaurant shutdowns. I think you covered that probably after we got a few of the questions. And the point that I heard you make is if you have in-room dining and you had limited occupancy, then most likely you're going to have a shutdown. That's more than 10% of the business. I think the few exceptions to that have been primarily, counter order takeout restaurants that they might have limited occupancy, but if they have two small tables in the restaurant kind of for convenience, but that's not more than 10% of their typical business, then it probably wouldn't qualify as a shutdown. The other thing that came up there, Jason, you mentioned tips being included for employees, and I think based on what we looked at, tips are going to be includable as gross wages. So we had a few questions on that as well.
Yeah, back to the shutdown aspect, I think one area that affects a lot of people that they don't even think about is there were a number of government orders limiting hours of operation. And so while they were able to operate, they weren't shut down. Retail stores had limited hours of operation where they were shut down, maybe they originally 9 to 9 on their hours, and the government came along and said, no, you can only be 11 to 6 or something like that. We want to limit the amount of hours that people are open. They also limited capacity, but capacity is a little harder to quantify, because if they limit your capacity to 25%, I mean, clearly I think that does meet the definition of a partial shutdown. But at some point you have to say, okay, they also indicated that if you can continue to operate without it impacting your operations too much, and you're at 50% capacity, which, most places you think about, a grocery store that you go into, you look at what's their capacity. If you look at the capacity before Christmas Day or Thanksgiving Day or a big holiday, you can see how many people are in there. During the pandemic, you would have had, it would have been hard to say that even at 50% capacity that they were limiting. Now, we did have early on people waiting in line and things like that, but those hours of operation, that's much easier to quantify, and that's where I think we're finding it easiest to bring people in to a government shutdown based on that.
Yep. A couple other, more kind of basic eligibility. From a gross receipts perspective, I got a few questions. PPP is not included in gross receipts, as well as I believe the emergency loans from the federal government. Other grants, you might need to look to the specific grants. I know for nonprofits, for example, grants are included in gross receipts, so would refer you to 2021-20 for that one, just based on your specific circumstances, but not PPP, which is obviously a huge difference for a lot of companies. And then from a headcount, full-time equivalent calculation, just to note again there, when we're looking at the 100 or 500 full-time employees back in 2019, or average full-time employees, that's purely for eligibility and to determine whether you're a small taxpayer for purposes of the definition there. Once you qualify, let's say you have 99 employees in 2019 and you qualify for both years, it doesn't matter how many employees you have in a qualifying period in 2020 or 2021, or whether they're full-time or part-time. Once you know your qualifying period, it's whatever individuals you have on payroll up to $10,000 of their payroll for whatever period that is.
Yeah, and I think it's important to point out some of the things that would surprise you. We have engagements with large franchisees that have, hundreds and hundreds of employees, but they're operating a lot of those with part-time help. And so that part-time help does not factor into the number of full-time employees. And so we've seen taxpayers with 1,000 employees meet the 100 full-time criterion because they just don't have that many full-time employees. Mm-hmm. So I think that's something that just to point out to people, so that they're not automatically ruling somebody out thinking, well, they've got way too many employees to qualify, because when you start looking at that full-time, it's not full-time equivalent too. I think that's important to make that distinction. Mm-hmm. I think some people were so used to that under the PPP rules that then you have to go through that exercise of actually doing the calculations to know for sure.
Yep. All right. Got a few questions on PPP and ERC interplay. So I know you kind of went into a couple examples there, Jason, but maybe I'll just kind of address the simple example of a couple I just got. One was, if an employee has, let's say, $30,000 of wages in a quarter and it's a qualifying quarter, can I use $10,000 of wages towards ERC and the other $20,000 towards PPP? And I would say generally your answer might come to close to that answer, but we're looking at the specific paychecks and pay periods for each employee when we're doing that. So there's no PPP rules that we've seen that require you to go sequentially or in order by date. Based on that PPP payment, you have to be within that covered period. But generally, we're not using it as one big bucket of money for the quarter and taking $10,000 out of it for ERC. We are going by specific payroll period. So I would just caution you to view that as one big bucket of money.
Yeah, I think that's a really important point, because at the end of the day, when borrowers are submitting to the bank for forgiveness, the bank is going to have a conniption if they can't tie back to some sort of number. And I think in some cases, some practitioners are sticking just payroll by payroll, And, I don't have a problem with that because I think that, the banks are going to really struggle with if you do, and we've seen some taxpayers say, look, I want every last dollar, I don't care. Then we can go paycheck by paycheck within a payroll. But I think that's going to be hard for the banks. I think it's going to be hard when the banks are trying to reconcile because they just don't have the information or the skill set or the time to get into those details. So there is a risk that when you get aggressive like that it will cause some heartburn for the banks. We do have at the moment, if you're looking at somebody who got money for PPP Draw 2 in early February, you have a little bit of time that you can look back and see, well, did they qualify enough? You can kind of figure out how much leeway you have between ERC and PPP, because you do have until we file a Q2, which is not until sometime in early July.
Another one just from a time period, between the government shutdown and the gross receipts test. Just to be clear on that, if you qualify for a shutdown, let's just say it's for March 15th of 2020 through April 15th of 2020, you're only going to qualify for that specific time period and the wages paid during that time period. Where if you qualify under the gross receipts test, you're going to qualify for the entire quarter that you fell under the threshold there, until the end of the next quarter that then exceeded the threshold. So generally, you're going to get 2 quarters at least under that gross receipts test. And for the government shutdown, it's just going to depend on the exact dates of your shutdown. So it's going to be generally a more limited rule to qualify under.
Yeah, it reminds me, one thing I don't think I talked about today is the Q4 rule. And that is if you were down 20% or more in Q4 when compared to Q4 2020 when compared to Q4 2019, that qualifies you automatically for Q1 of 2021. So, and certainly here in California, things were pretty crazy in December and January. So a lot of the folks that we see out here on the West Coast are definitely down greater than 20%. Certainly that means that they would qualify in Q1. Even if they were up in Q1, they still qualify for Q1 based on their Q4 qualification. And so that's an election, that look back election. Once you kind of make that election, then you have to look. If you don't qualify in Q1 for Q2, then you wouldn't qualify for Q2 unless Q2 met the criterion of being down 20%. So, it's just a little nuance there, but important. I want to make sure I'm bringing that up.
Yep. Yeah. So that's generally, a good way to potentially qualify for Q1, but it's the only time that you won't automatically get 2 quarters under the gross receipts test.
Right.
You still could get 2 quarters if you end up qualifying again in Q2.
Yeah, that's important to make that distinction as well. Once you qualify until you're greater than 80%. So that means that if you qualify in Q2, that if you get over 80% of your revenue when compared to 2019 in Q3 still qualifies, but you wouldn't qualify for Q4. So that's how that works. That is the one, if you qualify based on the revenue, you in almost every case are going to get 2 quarters.
Yep. I had a couple questions on kind of foreign parents. Generally, the rule there is your U.S.-based employees of that foreign parent would need to be included for headcount purposes for your headcount eligibility, but your worldwide gross receipts for that foreign parent would need to be included from a gross receipts test perspective. So that's a little bit of difference there between those 2 rules for foreign parents that we've seen, and it obviously can make a big difference. But I think it at least helps some clients where they don't have to include the worldwide headcount.
Yeah.
So I know.
Couple more minutes here.
Yeah, I saw a lot of questions come in the last few minutes that I haven't had a chance to kind of look at. But, we'll hopefully get back to you guys. We're going to look through those on the back end. I think most of them were covered one way or another through our presentation here. Maybe the one last scenario that I saw early on is for schools. Let's say a private school switching to remote learning, as most schools did. In that case, and I think I've responded to this one, but in that case, it would probably be the time that you had to switch to remote learning and to being able to do that work remotely. Otherwise, once you're fully remote, it's going to be kind of hard to qualify that as a shutdown. Any thoughts on that, Jason?
Yeah, well, I think it's interesting because, under the FAQs, when you look at what their examples are, the students kind of qualify as the customer in this case. So, it's interesting how it's really whether or not the employees, the teachers, are able to have access. And so I think you're right. If there was a time period where they were shut down because the teachers had to get infrastructure in place to be able to teach remotely, and I know, certainly I saw that with the public school environment where there was a period of time where it took them just to get up and running. Definitely there would be, it sounds like a partial shutdown. So thank you very much for joining us today.